Welcome to Cat Eye U.S. Stock. We watch markets with calm focus and sharp instincts. It's Tuesday, January 27th, 2026, and the market? It looked downright split. The S&P 500 closed above 6,970, another all-time high, while the Nasdaq climbed almost 1%. But at the same time, the Dow dropped more than 400 points, as one of Wall Street's so-called safe sectors went into full panic. So tonight, we're breaking down that split-screen tape. Why tech and AI kept the headline indices levitating, while health insurers just capitulated underneath. Pull up the S&P 500 heat map, and the story jumps out right away. Roughly two-thirds of the board was green. The brightest clusters were in tech, Microsoft, Nvidia, Apple, Amazon, Broadcom, and across key semiconductor names, with Micron almost glowing off the screen. Industrials and energy threw in solid pockets of green too. Think RTX, GE, Exxon. But scattered through that sea of green, you had deep red craters in healthcare and classic defensives. UnitedHealth, Eli Lilly, other pharma and managed care names, plus staples like Walmart and Costco leaning red. Financials were mixed, with Berkshire a notable laggard. And utilities? Small, mostly pale green, barely moving the needle. That heat map wasn't random, it was a very deliberate rotation. Capital flowed toward growth and cyclicals, especially AI-levered semiconductors and megacap software. Micron ripped on aggressive price targets. Microsoft and other cloud names caught a pre-earnings bid. Broadcom rode the AI networking story. Put it together, and traders were clearly willing to pay up for the AI stack. Industrials joined the party too, with aerospace, defense, and heavy machinery drawing buyers. And energy names like Exxon benefited from the weaker dollar and firm commodities. To fund all that, money came out of perceived bond proxies and policy-sensitive defensives. Managed care, high-multiple pharma, consumer staples, and parts of diversified financials were sold hard. Berkshire lagged as investors stepped away from conservative value and into higher beta tech and cyclicals. All of that left the market in a strange place. On the surface, it looked like a classic good market, bad sector day. The S&P 500 hit a record close, the Nasdaq jumped, and growth names looked unstoppable. Underneath, a single Medicare Advantage shock shattered confidence in what's supposed to be a defensive corner of the market. UnitedHealth's collapse and the broad insurer drawdown showed just how thin conviction really is in regulated, economically sensitive names. Participation stayed uneven. Leadership stayed crowded around AI and megacap platforms. And with the Federal Reserve kicking off its policy meeting and consumer confidence softening more than expected, traders are basically pricing in hope in growth, while bracing for more policy-driven squeezes in defensives. That tension, that split, is the backdrop heading into tomorrow. On the desks, three storylines dominated the chatter, and none of them are settled. First, Micron. Traders passed around ever higher price targets and talk of DRAM and HBM shortages stretching into 2027. Some desks saw today's spike as the early stages of a blow-off. Others argued it's just another leg in a multi-year AI infrastructure build-out. That debate is nowhere near resolved. Second, Medicare. The Trump administration's surprise stance and flattish rate implications had people asking whether the entire managed care complex needs to be repriced. A few even floated the idea of broader reimbursement or drug pricing moves later in the cycle. Pure speculation for now, but it weighed heavily on sentiment. And third, big tech options. Implied moves on Microsoft, Apple, and Meta into earnings looked rich to a lot of volatility desks. Instead of all-in call buying, the flow leaned toward call spreads and overwriting, ways to stay long the upside without betting on a full melt-up. None of this is confirmed fate, but it's the rumor mill that's shaping how risk is being taken tonight. What if I told you $500 billion could quietly leave U.S. banks? Not because of a crash, not because of panic, but because of stablecoins. Today, Standard Chartered warned that up to $500 billion in deposits could move out of U.S. banks by 2028. And here's the part most people miss. This isn't money going into wild, risky crypto trades. It's going into digital dollars backed by U.S. treasuries, outside the traditional banking system. That means fewer deposits, tighter margins, and the biggest pressure lands on regional banks, not the Wall Street giants. This could quietly reshape banking, payments, and regulation. If you want to understand who wins, who loses, and what breaks next, keep watching. UnitedHealth stopped being a safety trade today. The stock plunged nearly 20% after investors digested the Trump administration's proposal to keep Medicare Advantage payment increases near negligible levels, well below what the street had penciled in. That single policy shock forced a wholesale risk repricing across managed care. Humana, CVS, Elevance, they all sank in sympathy. And because the Dow is price-weighted, UnitedHealth's collapse by itself helped pull the index down more than 400 points, even as the S&P 500 and the Nasdaq held up. It was a textbook reminder of how one heavyweight can distort a benchmark and how fast a defensive sector can flip into a stress point when policy moves. Micron was the purest expression of today's AI chase. The stock ripped higher after another round of aggressive price target hikes, with one shot moving to about $480 and others leaning hard into talk of DRAM and high bandwidth memory shortages stretching into 2027. That built on already strong earnings and guidance and turned Micron into a bright green beacon on the heat map, a major contributor to semiconductor strength and to the S&P and Nasdaq gains. But the tone on the street was mixed. Some desks saw a disciplined bet on a multi-year AI infrastructure cycle. Others worried the trade is getting crowded and vulnerable to even small hiccups in execution or demand. Microsoft quietly did a lot of heavy lifting today. The stock pushed higher as traders positioned ahead of earnings, leaning on the ongoing AI and cloud narrative, Azure growth, Copilot adoption, productivity gains. Options desks flagged that implied moves into the print look rich after a strong run. So instead of chasing outright calls, a lot of the flow centered on call spreads and overwriting ways to stay long, but with guardrails. Given Microsoft's huge weight in both the S&P 500 and the Nasdaq, how this stock trades around earnings will ripple straight through the broader indices and through sentiment on enterprise AI spending more broadly. Apple joined the mega-cap bid. Shares climbed as investors leaned into buzz around strong iPhone 17 demand and more upbeat sell-side commentary heading into the company's January 29th report. That optimism is running alongside some ongoing worries, from App Store scrutiny to questions around payments tied to Google Ads. But for now, the tone in the tape was constructive. And because Apple is so large in both the S&P 500 and the Nasdaq, even this kind of modest pre-earnings bounce has an outsized impact on the benchmarks and sets the stage for a very consequential reaction when the numbers hit. UnitedHealth wasn't alone on the downside. Humana, CVS, and Elevance were all dragged sharply lower, as the market treated the Medicare Advantage proposal as a sector-wide problem, not just a single-name miss. The day's move basically broke the defensive narrative around managed care. These names stopped trading like safe yield and started trading like pure policy options. Crucially, broader credit and volatility markets stayed calm, signaling that for now, traders see this as a contained healthcare shock, not systemic stress. But the halo around insurers and around select pharma names is clearly gone. Outside of tech, RTX showed there's more to this rally. Shares pushed higher, helping lead aerospace and defense as investors favored names with solid backlogs and resilient demand. That strength, alongside gains in heavy machinery and select industrial peers, added non-tech leadership to an otherwise tech-centric tape and helped support breadth in the S&P 500. It wasn't a blanket defense chase. Other names, like Lockheed Martin, were more muted, but RTX's move underscored that earnings-backed cyclicals are still very much in play. Exxon Mobil quietly added some old economy muscle to the tape. The stock moved higher as energy names benefited from a weaker dollar and a steady commodity backdrop. For portfolio builders, Exxon and its peers offered a way to express a risk-on view without adding yet another chip or software name, cyclical value to sit alongside AI-heavy growth. That mix of green in energy, industrials, and tech is what ultimately allowed the S&P 500 to overcome the healthcare wreck and still close at a record. So where does this leave us going into tomorrow? The Federal Reserve has just kicked off its first policy meeting of 2026. Markets broadly expect rates to hold in that 3.5% to 3.75% range. But the guidance on cuts will matter for everything from small cap funding to bank margins. On the equity side, we're heading straight into a wall of big tech earnings. Microsoft, Apple, Meta, with options markets already pricing in chunky moves. Those prints will either validate the current AI and mega-cap premium or force a rethink. At the same time, any fresh commentary on Medicare reimbursement or drug pricing will be watched closely after today's shock. And under the surface, traders are tracking whether small caps and non-tech cyclicals can step up or whether leadership stays crowded in the same AI corridors. No forecasts here, just a market-leaning risk-on, with plenty of event risk still to clear. To wrap it up, today's tape sent a pretty clear message. Investors are still willing to pay for growth, AI, and select cyclicals. Enough to push the S&P 500 to new highs and keep the Nasdaq climbing. But the brutal move in health insurers showed how quickly a policy surprise can crack a supposedly safe sector and turn a headline Dow drop into something that feels very different from a record-high S&P. Heading into tomorrow, the real question isn't just where the indices open. It's whether leadership broadens beyond the AI core, and how much policy and Fed messaging this market can absorb without breaking its current uneasy balance between hope and growth and fear and defensives. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.